Very good evening for all the participants. At the outset, I want to thank those who have taken this Friday evening to attend this webinar on behalf of PMS Bazaar. My name is Sivaram. I'm going to be the host for this program. To make the evening more interesting, IDFC Asset Management Company is joining to present a unique and first of its kind PMS strategy called Neo Equity Portfolio, where data, portfolio manager, and the machine are going to work in tandem on a proprietary module to create a risk-reward balanced portfolio for a desirable outcome. What is required to create a portfolio of this nature is a fund manager who is a computer scientist by education with financial expertise coupled with quantitative portfolio manager. All in one is required to make a portfolio work. Let me take the privilege of introducing Mr. Chetan Mehra, who is Head of Quantitative Investment in IDFC with about 20 years of total experience. And he is very rarely seen in the public eye through media. And if I can call it so, sir, and you are a media shy person. Okay. And he's a PhD in computer science and MBA in finance from University of Leeds. Worked for very large organizations like Deutsche and Merlin earlier. Mr. Mehra's PhD was focused on data science approach to build a smart portfolio. Mr. Mehra handled equity and multi-asset portfolio in the earlier assignments. After Mr. Mehra's presentation, the forum will be open for question and answer. Please feel free to ask any question, as this is first of its kind and a very different strategies adopted by Mr. Mehra in this particular PMS. And generally people will think it is a quant-based PMS. Actually, it is not quant-based. In the presentation, Mr. Mehra will go through what the strategy is all about. Now I hand over the forum to you, Mr. Mehta. It is all yours.
Thank you very much, Sivaram, for the kind introduction. And thank you everybody for joining us today for this presentation on Neo. I hope I'm audible and visible. So I like to start with a brief introduction of what we do and what this technology, which we call artificial intelligence, is about. And why it is important, and why it is significant, and why it's already in our lives. The concept of AI started in the 1950s. It is an extremely powerful methodology if you know how to use it properly. It has become very, very significantly present in business and all sorts of analytics globally in the last 20 years. Last 10 years being the most significant ones. I would compare this technology to the Industrial Revolution of the 1750s to 1850. We had an industrial revolution where the world took a quantum leap. And I mean, when I say a quantum leap, I mean in every sense of the word, whether it was travel, business, education, because we were developing things where a manufacturer, for example, a manufacturer of shoes could make better, cheaper, and more pair of shoes and sell it at a higher price, where the consumer was ready to buy the product at a higher price because it was better quality. Why? Because the technology uplifted everybody. You made a cheaper shoe, it was a stronger shoe, and you could make more of it, so you were profitable. The consumer was ready to pay a higher price, and consumer was ready to buy more of it because it was a good quality shoe. When this kind of confluence happens once every 200-300 years, a technology comes around which lifts everybody. It just enhances everything that we do today. It transforms everything we do. So this is what artificial intelligence is doing. And whether we like it or not, it is in our lives. So today, we all carry smartphones, laptops, fitness trackers. I have a fitness tracker here. We use Uber, we use Zomato, Swiggy for food. We generate a lot of data. This data is stored. And with this data, companies can actually customize services that we want. Things we are not even aware of, that somebody may like Chinese food or a certain kind of beer on a Friday. This app will know because it records your behavior. And today, the world is generating so much data that in a 2016 study, it was said that in every 8 months, we were doubling the amount of data on the planet. That is a huge amount of data. And the beauty of this situation is today storage is very cheap. Data storage, if you remember buying a USB stick 10 years ago, and the cost of a USB stick today, and the capacity that you get, you will see that it has literally, you can buy 10 times at the same price. So data storage is cheap, computing is cheap, and everybody's carrying literally a laptop in the form of a smartphone in their pocket. So you are creating data, your life is improving, but you don't know this is AI. You think this is some app, but nobody knows what are the analytics, what are the engines behind this. When an app tells you to take a different route, when Uber comes up and also suggests that you want to order Chinese food on a Friday or a Saturday, this is all probabilistic models running in the background. So we are using it, and it is touching our lives, and it has been touching our lives for the last 20 years, but it is more so today. And I will take the example of a very, very famous company now. It wasn't so famous then. It's called Netflix. And everybody is now aware of Netflix because we have all used it during pandemic because we couldn't go out. In the year 2009, Netflix promoted a competition where the prize money was $1 million. This is 2009. And you were supposed to recommend the next movie or the next TV series. And somebody had to come up with a system how to recommend that. So today, when you finish a TV series, and when Netflix says, people who saw the series you saw also liked this one, that's the outcome of this this championship, this competition. And these systems are called recommender systems. So the point that I'm trying to make here is AI is everywhere. It is impacting every aspect of your life, whether it's finance, whether it's healthcare, whether it's entertainment, banking, loans, everything. But we are not sort of aware of it because it's a very specialized field. So in Neo, we use what is called machine learning. Machine learning is literally 95% of AI. Machine learning is where you use algorithms from computer science to build models. And it's not one or two algorithms, there are thousands of them. It depends on the kind of data you have and the sort of problem you're trying to solve. So what you need for AI and for machine learning to work is you've got to have domain knowledge. What does that mean? That means that you should know the problem you're trying to solve. The methodology is very, very powerful. The algorithms are very, very powerful, but you should know how to define your problem well for the algorithm to solve it. Most of the time, the challenge is people who know machine learning don't know anything about, let's say, finance. People who know a lot about finance don't really know how to use machine learning. And this space becomes tough because you need, I would say, expertise in four subjects. You need to know finance, you need to know programming, you need to know algorithmic theory, so algorithmic game theory, and you need to know statistics. That's a whole lot of education to have. And once you have that education, you have to figure out how all four of these connect. So it's a considerable amount of work. So it's not as easy or as people would like to show that, oh, we did this with AI and it was so easy. There's actually a whole lot of work behind it. AI-based models are distinct from quant models. Because we've all seen a lot of quantitative models. So anything can be quantitative. If you can count, it can be quantitative. But the big difference between a machine learning model and a quantitative model is that a quantitative model comes from a book. The equation is defined. You simply take that equation, you pass the data through it. And once you pass data through it, it'll give you some parameters, and that's your model. That's your mathematical model. In machine learning, there is no model. There is just an algorithm. And the job of this algorithm is to discover the model. Now, how does that work? In machine learning, you have an algorithm and you have a data set. So you have historic data sets of which you use. And what happens is, let's say you have 1 million data points to solve a problem. You will typically break that data set into, let's say, 1,000 pieces of equal size. And the algorithm will start on the first data set, first part. It will make a small prediction. It will find what the error is, note it, then increase the window size. So it's 1 plus 2, so it's a bigger data set. Then it tweaks a model, then fixes the error rate. So what it is doing is it is discovering a mathematical equation over many, many thousands of steps. And by the time it reaches the end, it has found a reasonable model. Now this model can be fundamentally different from a quant model, or it can be quite similar. But it did not come from a book, and it was learned from the data. So the strength of an AI model is that as the data changes, the model will also adapt. Whereas in a quant model, the model is static. It will stay the way it was from a book. You can't change that. So that is the big philosophical divide between a machine learning model and a model which comes out of a book. In a lot of other methodologies, people pick stocks. I have a company which is in it could be, some people used to say, I have Divi's, or I have HDFC, or I have Infosys. These are great stocks. For the work that we do in Neo, a single stock doesn't matter. We look at factors. We build exposure to factors. What does that mean? What is a factor? Now, return on equity is a factor. Dividend yield is a factor. How does that work? So, for example, somebody decides that they must have exposure to information technology sector. Now, somebody will say, okay, what is the best stock in information technology? Let's say it's Infosys. You say, I go and buy Infosys. So you have built an exposure to information technology in just one stock. In our approach, if you were to build exposure to information technology, you would buy most of the information technology stocks in small quantities. So you build exposure to a factor. Here, the factor is a sector. So you don't expose yourself to one stock and company-specific events. You expose yourself to something which is a lot more stable. If our model says that you must have exposure to IT, we are not going to have exposure to one stock or two stocks. We'll have exposure to all the stocks which are in IT, which are in our universe. So that's the big difference. You're not talking about superstar stock or we have a very large position in X stock. We are supposed to build exposure to factors. We could be building exposure to dividend yield. That doesn't mean we pick up the stock with the highest dividend yield. We find the best stocks which have the highest dividend yield, and we buy all of them. So the idea is you don't bring in stock-specific risk. So stock-specific portfolio management is very retail. It's really is a very retail approach to building a portfolio. A factor-based approach is a very institutional approach to building a portfolio. For example, people who use factor-based models are large institutions, and these people are not managing 3,000 or 4,000 crores. They're generally running north of $250 billion. So when they build exposure to, let's say, a factor, if they're trying to go for growth, they will find the countries with the highest growth rates. So let's say it's China and India, for example. That's the macro aspect of it. And then within China and India, they will find stocks which grow the most. So factors which you have, which impact a single company, like return on equity or dividend yield, they are driven by the bigger macro picture, bigger macro factors. Growth rate, inflation, GDP, unemployment rate, all of these things eventually are impacting the behavior of the economy and the company's behavior in their management of their finances in the economy. So you end up driving, even though you're picking up company-specific factors, you are actually, the impact of that comes from the macro side. The other big difference between a approach that we use and the rest of the portfolio managers, we use a very scientific process. That sounds like a mouthful. A scientific process is a process where you work based on evidence instead of some theory you read in a book or an article that you read in a magazine or some analyst wrote a report. You don't really care about those things. What you care about is, what does your data say? What does a company historically do when it has these kind of factor exposures? So you're looking for factor premiums. And the beauty of that part is that you don't have to ever look at the news or to read a certain set of reports. The data will tell you which path to take. And there is a statistical process to follow for that. So it is a fairly distinct approach compared to other quantitative approaches or other portfolio management approaches. So in the last slide, I spoke a lot about how we are using data. And data is the most important thing for AI. If you don't have data, you cannot do any AI. You cannot do any machine learning. So the quality of data is the most important thing for machine learning. We spend 75 to 80% of our time making sure that our data is clean, is accurate, is reliable at all times. If we ever feel that our data is not reliable, we throw it out. We just don't use it because the machine, our algorithm will learn it and hug it. Let me give you an example. When a company, let's say Infosys, releases its earnings on the 15th of June, that's called the release date. It depends on which day let's say a Bloomberg or Reuters picks up that data point. So let's say instead of picking it on the 16th of June, if they pick it up on the 7th of July, that's 3 weeks too late. That's called collection date. Then if it goes and inserts the data on the 10th of July, that's called insertion date. So we do a data audit. Why do we do all of these things? Because not only do we want the right data point, we need to know when will that data point be available. Now, if I look at 10 years worth or 15 years worth of history, I'm not sure. I can see when this data point is related to, but when is it released? When is it available? Those are the kind of audits we have to do before we say, okay, this data can go inside our model. This will be available to us in a timely fashion. Because there are many companies who will collect data, especially for mid-sized companies at a much later date. So we spend a lot of time understanding the source of our data, we audit our data, then we spend time cleaning our data. And once the data is cleaned and we are happy with it, we pass it through our algorithm, which essentially gives us an optimal portfolio. Once we have the portfolio ready, we really focus on risk management. We want to see whether there is something sector specific or company specific which has come out, because governments change laws, sector specific laws can change. Somebody can sue the company, or the company can come up with something. So some event can happen which impacts the company. And finally, we spend most of our time basically doing research. Most of our days are spent going through data and hoping to improve our model. That's the framework within which Neo and the team which manages Neo works. So how is our portfolio made? For Neo, we only focus on the BSE 200. If a stock is not part of the BSE 200, we do not include it in our portfolio. BSE 200 is also our benchmark. And the BSE 200 mostly has large and mid-cap companies. It has no small caps. And the reason for that is best quality data in India is available only for larger companies. For smaller companies, the quality of data is quite poor. And in many cases, some data points have actually not changed in 3 or 4 years. So having done our audit, we discovered some rather interesting gaps. So the BSE 200, we run a couple of filters. One is a filter of liquidity. When I started managing this portfolio, India was going through a bit of a credit crisis. There was a lack of liquidity for businesses, and a lot of these smaller stocks didn't trade so much. So we sort of remove the illiquid stuff, and there is a rule that a stock must trade at least a value of, on average, of 10 crores on average a day for the last 30 days for it to become part of our portfolio. We have a governance filter where we're sort of looking for red flags, where we are looking for primarily things like pledge shares. A lot of companies would go and pledge a lot of shares to raise money, or the promoter does it. That for us is a little bit of a red flag. It shows sort of mismanagement of finances. So we sort of include some of these things. And once we have, so we are getting rid of about 20 odd companies, 20, 25 companies. Once we have this universe ready, we simply feed in the data into our algorithm, and the algorithm gives us an optimal portfolio. So a question we are often asked is what all data goes into the machine. We put every data point which we think is a clean, valid data point into the model. How does that work? We essentially take all balance sheet information, all profit and loss information. So this is all fundamental information. We take price-related information, we take volatility-related information, and we feed it. And the objective here is to find the right balance between risk and reward. And that's not an easy thing to do. What we are trying to find is how do we make sure that not only do we make money, but we keep it, instead of having a nice up trajectory and then giving it all the way back. It's one of the things we don't want to. So we are always trying to control our downside. So I think it would be accurate to say that we actually care more about risk and how we manage our risk. And I'll show you how that has panned out for us. So typically, the point that I'm always trying to make to our investors is that our portfolio looks like a thali. Everybody's portfolio looks like a thali, and everybody sees, Infosys, HDFC, whatever. And what we are seeing are things like return on equity, dividend yield. So like in food, instead of seeing baigan ka bharta or whatever dal, we see proteins, we see vitamins, we see calcium, we see carbohydrates, because we are looking for the ingredients which make this company a good company on a risk-adjusted basis. And we want to see that feature reflected in all the entities that we pick up. So instead of saying, oh, this is a superstar company, or this is a superstar stock, or a superstar CEO, or whatever, what we are trying to do is we're trying to say, oh, this company has a great return on equity, and you get rewarded for getting great return on equity. So let's buy return on equity. Why don't we build an exposure to return on equity? So that's what the model sees. The model sees, I can get a reasonable return, and I can get it at low volatility. Let's go get that. Well, this is what I was talking about. So in terms of restrictions and parameters, we try to run not a very large portfolio. We run about 35 because, again, we are not trying to, again, pick up a superstar stock. What we are trying to do is build an exposure to a factor for which we need more stocks. Similarly, like instead of picking up Infosys, if you want to build exposure to the IT sector, you pick up all the stocks in the IT sector and build up a good exposure. These are some restrictions which we follow. Is no stock is more than 10% of the portfolio. No single sector is more than 40% of the portfolio. We actively watch out for risks that are developing in the market. Like, for example, earnings are being released now, and we are actively watching earnings misses, upgrades, downgrades. And our aim is to rebalance the portfolio every month. So, and typically the whole portfolio doesn't change. Only a few stocks will change. Some of the stocks we've held for almost 2 years. Again, companies which are good will typically keep coming up all the time. So as I mentioned, that the challenge and the objective for us is to always find a good balance between risk and reward. And I want to highlight this chart. This is from January to December of 2020, the year we got hit with COVID. And the machine didn't know our AI didn't know what COVID looked like. And frankly, neither did anybody else. We went in fully invested, and just want to point out some things. The BSE 200, which is our benchmark, hit a local high on the 17th of January. Neo's portfolio hit its high almost a month afterwards, and then the market sold off. And if you see, Neo fell less than the market. It was higher than the market, fell less than the market. And most interestingly, Neo had already come back to where it was in February by the 6th of October, where you see 107. So we peaked a month later here, and then we recovered by the 6th of October. We had actually just gone above. Whereas the BSE came up on the 5th of November, a full month after Neo. So we peaked a month afterwards, we fell less than the market, and we recovered faster than the market. And this is where what I'm trying to say is a good balance of risk and reward. We can see this reflected in sort of how we've done till the end of June this year. So if we start from January 2020 and we go up to today, you see we have fallen less, and we have continued to stay above the market. This is a very interesting chart. These are since March. I would say since April 2019, when I took over, when we made some changes to the model. These are the 9 worst months for the BSE 200. And 7 out of 9, only 3 times were we also negative on the market, but we've always outperformed the market on the way down most of the time. Not all the time. It's a long only portfolio. So the point is that the reason I'm showing you all of this is that we are actually quite serious about the balance of risk and reward in our portfolio. We don't build a go portfolio. We want the portfolio to be profitable, but when the correction comes, we want to hold on to that gain. On this chart, I want to highlight what is called the information ratio. The information ratio is a ratio which shows how much you are outperforming the market and with how much volatility. It's a ratio between return and volatility. So you can only have an information ratio which is positive or above zero if you are outperforming. And if you have an information ratio of 0.5, you are universally around the world regarded as excellent. And as you can see from this chart, given that there was a massive correction, etc., we have managed to keep Neo's information ratio well above 0.5. So we've done better than what a good portfolio investor would want. Again, we are outperforming the market, essentially, outperforming the market with lesser volatility than the market. So we are not just loading up on volatility and saying, oh, a market is going up, we should just go up with the market. And that sounds like a good idea. So it shows that consistency and finding the right balance is being done reasonably well by Neo. And this shows to the strength of our discipline of being strict with the quality of data that we use and the algorithm that we use and the balance it finds between risk and reward. So that's really what I have to say about Neo. If you have any questions, I'll be more than happy to answer them.
There are a few questions which has come in the forum to me. Abhimanyu Binani is asking, economic cycles are considered while creating a portfolio of this type.
Economic cycles?
Yeah.
What's your definition of an economic cycle?
See, this is the question. Perhaps he is thinking we are in the mid-cycle and the cycles, economic cycles, are being considered while creating a portfolio is what he has asked. He has not
specified what it is.
Specified anything in elaborate.
No, I'm not using anything from economic expansion or contraction.
All right, sir, thank you. And Pooja Agarwal wants to know, these types of funds have an traditional edge over value and growth investing types is what she wants to know.
So as I said, we use a scientific process. We try not to get ourselves trapped in any kind of belief system, value, growth. We have an exposure to all factors. And it is very hard to isolate a lot of these factors because of collinearity. We simply follow a scientific process. We find where the evidence is, where the premium is, and wherever our model says the premium is, we go there. There's no point for us to go in places where there is no premium to be had. So we try not to do this growth value thing. Especially when we are building our portfolio, we just follow a scientific process.
Yeah, one question which has come, how many stocks do you have in your portfolio? If you could answer that currently.
36.
All right, sir. Okay, and another question which has come as this kind of fund style is nascent for India, and where the international peers perform in AA-based portfolios in developed countries. You have worked abroad and perhaps you can throw some light.
Yes. So quantitative investing has been part of developed markets since the early 70s. The first institution which started hiring PhDs in mathematics and computer science was Bankers Trust. I started my career there in the 90s. They did that in the 80s. So broadly, quantitative investing has been around since the 70s. More and more machine learning and AI-driven investing started in a sort of a big way by 2000. There were small, very specialized pockets, but now it really is, because it is a superior approach to standard quantitative models, almost everybody shifted there. I would say well over $1 trillion are managed using these approaches. And the hedge fund space, I'd say well over $200 billion. So the hedge funds were the first ones to sort of start doing a lot of this, but now traditional asset managers use it. Fidelity is a massive user. They have a huge team. They don't rebrand their products by saying, "Oh, this has got AI." They just have a team of a few hundred people who are supporting portfolio managers in their decision making. Because when you start following evidence-based approach, it's hard to argue against it instead of just storytelling, which most people come out and say this, that, and the other. Like, for example, when I came to Bombay to work with IDFC, I didn't know half the companies that were coming up. We just followed a scientific process. Today, if somebody says, "Here's 100 million, build us a portfolio for Japan or Indonesia or I don't know Cambodia," I'd follow the same process. So the good part of using a scientific process is that it's logical. You can structure it, and you know how to assess it and be objective about it instead of saying, this portfolio manager was great, he likes this stock or whatever. None of those things matter. You simply rely on your analytics, and your analysis has to be solid. And for analysis to be solid, you have to follow a scientific approach.
You have answered this question. Still, a question has come whether you go for international shopping for your stocks. And you clearly told you are confined to India, that to BSE 200. And do you have exposure to international stocks is what someone wants to know.
Nope, we don't have any exposure. So Neo only invests in BSE 200 stocks. We do not buy bonds, options, futures, or anything outside the BSE 200, even related to the companies. Unless it's the straight stock, we don't buy anything. We can't even buy ETFs.
All right, sir. And the value at risk, which is the common methodology which is being used, and where it comes in artificial intelligence is what someone wants to know.
So value at risk is a very old model. It came out of RAROC, which was called risk-adjusted return or capital, which came out of Bankers Trust. Is not an AI methodology. It's just a statistical model. I can feed VAR into the model. I can feed any kind of data into the model, but it is not an approach from AI. It has a very long and strong history of being a model in its own right.
Okay. And how did the portfolio change during the market nosedived in March 2020? How many stocks you went out during that time depends on artificial intelligence model you follow. Is yes. What someone wants to know.
Yeah, so we didn't have, we just followed our process. I think we had a change of about maybe 2 or 3 stocks came in and went out. Typically, our portfolio has been less volatile than the market. So not a lot changed during the crash. We started seeing a pickup, a change in the kind of stocks that we were picking up around July, as the market started to sort of stabilize. July, August, we saw a little bit of a change in the kind of stocks that we are having. But one of the things that happened definitely, which we didn't expect to the extent that it happened after the pandemic crash, was that the volatility, intra-sector volatility went up considerably. Factors which typically don't work in India started to perform very well. And there was a tremendous amount of rotation which happened within sectors. And so that was a little disconcerting, that the volatility within the market was quite horrendous. And then, as we know, the period of November to February once the vaccine came out was everything just worked on the upside down. Everything that was bad or going bankrupt went up, and everything that was good and was going to survive in any case, just started to underperform. So it was in many ways a very difficult time, because the macro economic situation, not only in India and globally, changed. The US, well, not just the US, every central bank in the world flooded the world with liquidity. You had a flood. US, if you look at, put everything, whether you put moratoriums, credit lines, forgiving loans, everything, we put it all together, almost $16 trillion worth of credit came into the system, and it overflowed into the Indian market and international markets. So yeah, a lot of people who thought that this is not going to work, they obviously didn't see what the monetary policy impact was. So yeah, it was a very difficult time, but we let the model do what it's supposed to do, and it didn't disappoint us. I must say, I was a little worried that it would not handle a lot of things, given the situation everybody was in. We just said, okay, let it do what it does, and we were fine.
Can we go to the next question, sir?
Yes, please.
Okay. And how often you run this AI to decide whether to continue or discontinue or cut positions in a stock? Is it a continuous process?
No, it is not a continuous process. We run it once a month. We try to run it around the middle of the month. But when earnings come out, we wait for the new data to come in. Because once a company has reported, there's always a call, there is some sort of an upgrade or downgrade of the stock. We feed that data into the model. So not only balance sheet data, but we also take analyst upgrades and downgrade recommendations are also fed into the model. So when that is happening, when earnings are coming out, like right now, we have earnings coming out, we do a staggered rebalance. We don't do a rebalance of the whole portfolio. We wait for a company which may be sitting in our portfolio and has come down and it has to go out. If it's, if there's in 2 days' time, if they are reporting, then we will wait those 2 days. But typically we just run the model and we see what comes in and what goes out. We do watch out for risk events. So we don't really get involved in doing anything on a day-to-day basis on the portfolio. But if something has happened which is going to impact the company that we hold, then we might intervene. Like there is a risk event. Like there was the Infosys rumor which came out, and I remember Infosys opened 18% down on the day. I was overweight. I'm still overweight Infosys, but we took a very sizable hit. We didn't react on the day. We did some analysis and we sort of reduced our position size. So that's when we sort of involve when there is a risk where something may fall off a cliff and not sort of come back. So there is a risk event. But if there is no risk event, we just let the model tell us what to get in and what to get out.
In your proprietary module, and the valuation goes beyond your comfort, do you exit or you reduce position from that stock?
No, we don't. I don't have a comfort. The model has the comfort.
All right, sir. Sir, there are a lot of other questions which are coming up, and we will send it across as we are running short of time. Definitely, it is a very different webinar which we have conducted earlier compared to those. This is a very different methodology you follow. And is there any closing comments you want to give for the investors? And basically, for whom it suits, and definitely everyone wants returns while the risks are to be least. And definitely your product is the answer is very clearly coming out from your presentation. Is there any closing remarks you want to give for the listeners, sir?
Sure. So I'll speak a little bit about Neo and who it suits. So Neo typically suits a sophisticated investor, an investor who wants a reasonable rate of return and wants a balance of risk and reward. So I meet a lot of investors who they only ask me one question: how much money can your model make? I can give them a model which makes them a lot more money um, than what Neo makes. But the question is, what are we trying to solve for? We are trying to build a portfolio of our clients over the long term to give them a risk adjusted return which is superior, so given by our information ratio. So a person who has savings of a considerable size and wants to invest with us and wants somebody responsible to take care of the downside, um, is really what our ideal investor, because there are a lot of people who have no concept of risk. They just want to see returns at any cost. We don't do that. That's not how we are trained. You got to have a balance between risk and reward. Um, in terms of our approach and methodology, all I can say in conclusion is India is a market where more and more of these methodologies are going to be used, not only in finance, in medicine, in healthcare, in your studies, everywhere. You just cannot escape it. It's a tool which is going to enhance every business, every doctor's life, every patient's life. It's a very, very powerful methodology. And for me, it is like the Industrial Revolution, as I said in the very beginning. Countries which adopt it will have a quantum leap into the future for their entire population. Countries which miss it will be just like the Industrial Revolution. You look at Europe and you look at Asia, countries which did not follow the Industrial Revolution, where they are even today after 300 years, and countries which sort of participated in the Industrial Revolution, where they are after 200 years. Similarly, it's going to happen with AI. So it is upon us, it is here, there is no escaping it. And we just have to adopt. It is a superior methodology. The sooner you become friends with a superior methodology and learn it, the better it is. That's all I have to say.
If the model allows you to have lesser number of the stocks than you have currently, that is 35, and what will be your reaction to the AI data which is being thrown, that you can have, say, lesser number of stocks? He has not specified how many stocks. Say about, for an example, about you can accommodate only 15. And what happens to 10% cap you have on a stock?
Sorry, what? I don't understand the question.
Suppose that the data which is being thrown by AI wants you to come out of stocks from, you have 35 now, it allows you to have, say, only 10 or 15, and the 10% cap will be taken off, and will you go higher allocation for a single stock is what?
Not at all, no. We actually don't want 15 stocks. We don't even want 20. We want as many stocks. Because the moment I bring my universe down, I expose my model to company specific risk. The more I diversify in terms of companies, the less company specific risk. I have more factor specific risk. Of a factor, I have also risks, but it is a more stable risk. It is a risk which perpetuates throughout the entire economy. If interest rates go up, there may be a specific company, because it is in the financial sector, it may be impacted in a very different way. But if I have a diversified exposure to all stocks, the whole impact is going to be spread out. At worst, I will do as bad as that company. And the chances are that I will do much better if there is a change. Now, nobody can escape an interest rate change. Every company is trapped. You cannot escape the policy of the Reserve Bank of India. The cost of capital, how it impacts a certain company, and that company might be very, very heavily exposed to the interest rate risk. While my 15 companies instead of one of that company will most certainly diversify that risk away. So you got to know what the drivers are. You got to know how to protect yourself. And we at I would say 90% of the time, we know why are we making money or why are we losing money, because we dissect every aspect of the market, even in our analysis. So I think people who go and build portfolios of 20 and 15 and 12 models are taking way too much risk, and they are not communicating it. I think it's foolhardy.
Right, it is well said, sir. And in fact, most of the investors, we communicate with them on a daily basis. Definitely, they wanted the risk is what they talk about as a first criteria. Then only return comes as the market is nearing all-time high. What is your outlook on the market is what someone wants to know. If you want to answer them, you could throw some light on what is your outlook about the market, say in the short term, that is 1 year, or in the longer term, 5+ years. What is your outlook, sir?
See, we are model driven. So, but I read what is happening. I've run a macro hedge fund in my life. So I ran a global fund. So I look at what's happening in the globe. What really matters is, as long as there is enough liquidity in the markets will stay up. They may not go up forever, but they will certainly not just fall. Till the US central bank decides, the Federal Reserve decides to pull liquidity into the system, out of the system, the market will stay frothy. And they have already very clearly stated this good 1 year ago, that till we get full growth back, till we get full employment back, we will have a loose monetary policy. And we've already seen a pickup in inflation in the US and a fall in the 10-year. The US 10-year rates will always accommodate for inflation and growth. That's called the Fisher equation. In India, that is not the case. The Indian 10-year does not represent inflation or growth like it would in the developed market. So as long as the developed market central banks are pushing in liquidity, the markets stay up. Then people say the markets are looking irrational. The markets have never been rational, starting from the South Sea bubble going back to 15, whatever. I've never seen a rational market. But yes, things look expensive, sure. Things can go down, sure. But there has to be a trigger. It will be driven by central banks. And this is why I was at pains to explain that the factors that we use, which are micro factors, company-specific factors, are directly impacted by macro factors. Those macro factors drive that environment within which micro factors sort of come in and impact the behavior of a company. Longer term, 5 years, I mean, why would I make a forecast that long? Nobody knows what's going on.
Sir, the last question I want to ask is, is there any expansion for Neo if someone wants to know? You want to answer NEO, what it stands for? Is there, why have you kept the name?
Neo, I didn't keep it, the company kept it. Neo is Latin for new.
All right.
It's in Latin.
Okay.
And I think somebody who suggested this might have come from that Matrix movie. It might have. I'm not sure. I will ask. It's a good question. I will ask why it's called Neo. But Neo is new in Latin. Latin is a dead language, unfortunately. But that's what it means.
It is wonderful, sir. And in fact, I have enjoyed, this was one of the most enjoyable webinars I have attended and I have conducted rather. And in fact, It was a very different concept you have brought in, which is a niche in India still. I hope and a lot of investors also must have enjoyed the way you have explained a difficult concept in a very simple few slides. It is wonderful to have you in our webinar. May God bless you. Stay safe, sir. Thank you very much.
Thank you very much. Thank you, everybody, for joining. Thank you.